If you manage a team, there's a good chance you've heard of key performance indicators, or KPIs. In its simplest form, a KPI is a type of performance measurement that helps you understand how your organization or department is performing. Today, we will tell you what are KPIs. Before starting the video, please subscribe to the channel and click on the notification icon so you would get notified when we upload the next video. Number 10, what are key performance indicators? KPIs. Key performance indicators, KPIs, refer to a set of quantifiable measurements used to gauge a company's overall long-term performance. KPIs specifically help determine a company's strategic, financial, and operational achievements, especially compared to those of other businesses within the same sector. Key performance indicators measure a company's success versus a set of targets, objectives, or industry peers. KPIs can be financial, including net profit, or the bottom line, gross profit margin, revenues minus certain expenses, or the current ratio, liquidity and cash availability. Customer-focused KPIs generally center on per-customer efficiency, customer satisfaction, and customer retention. Process-focused KPIs aim to measure and monitor operational performance across the organization. Generally speaking, businesses measure and track KPIs through business analytics software and reporting tools. Number 9, understanding key performance indicators. Also referred to as key success indicators, or KSIs. KPIs vary between companies and between industries, depending on performance criteria. For example, a software company striving to attain the fastest growth in its industry may consider year-over-year, or YOY revenue growth, as its chief performance indicator. Contrarily, a retail chain might place more value on same-store sales as the best KPI metric in which to gauge its growth. Key performance indicators gauge a company's output against a set of targets, objectives, or industry peers. Number 8, importance of KPIs. Key performance indicators shine a light on how well a business is doing. Without KPIs, it would be difficult for a company's leaders to evaluate that in a meaningful way, and to then make operational changes to address performance problems. Keeping employees focused on business initiatives and tasks that are central to organizational success could also be challenging without designated KPIs to reinforce the importance and value of those activities. In addition to highlighting business successes or issues based on measurements of current and historical performance, KPIs can point to future outcomes, giving executives early warnings on possible business problems or advance guidance on opportunities to maximize return on investment. Armed with such information, they can manage business operations more proactively with the potential to gain competitive advantages over less data-driven rivals. Number 7, types of key performance indicators. Financial metrics. Key performance indicators tied to the financials typically focus on revenue and profit margins. Net profit, the most tried and true of profit-based measurements, represents the amount of revenue that remains as a profit for a given period, after accounting for all the company's expenses, taxes, and interest payments for the same period. Calculated as a dollar amount, net profit must be converted into a percentage of revenue, known as net profit margin, to be used in comparative analysis. For example, if the standard net profit margin for a given industry is 50%, a new business in that space knows it must work toward meeting or beating that figure if it wishes to remain competitively viable. The gross profit margin, which measures revenues after accounting for expenses directly associated with the production of goods for sale, is another common profit-based KPI. A financial KPI that's known as the current ratio focuses largely on liquidity and can be calculated by dividing a company's current assets by its current debts. A financially healthy company typically has sufficient cash on hand to meet its financial obligations for the current 12-month period. However, different industries rely on different amounts of debt financing. Therefore, a company ought to only compare its current ratio to those of other businesses within the same industry to ascertain how its cash flow stacks up amongst its peers. Number 6, customer metrics. Customer-focused KPIs generally center on per-customer efficiency, customer satisfaction, and customer retention. Customer lifetime value, or CLV, represents the total amount of money that a customer is expected to spend on your products over the entire business relationship. Customer acquisition cost, or CAC, by comparison, represents the total sales and marketing cost required to land a new customer. By comparing CAC to CLV, businesses can measure the effectiveness of their customer acquisition efforts. Number 5, process performance metrics. Process metrics aim to measure and monitor operational performance across the organization by dividing the number of defective products by total products produced. For example, businesses can measure the percentage of defective products. Naturally, the goal would be to get this number down as low as possible. Throughput time represents the total amount of time it takes to run a particular process. For example, a drive-through restaurant throughput can measure how long it takes to service an average customer, from the time they make their order to the time they drive away with their food. Number 4, how to measure KPIs. Once key performance indicators have been identified, they should be clearly communicated to employees so all levels of the organization understand which business metrics matter the most and what constitutes successful performance against them. This could include the entire workforce on broad corporate KPIs or smaller groups of workers on ones that apply to particular departments. In most companies, KPIs are automatically tracked via business analytics and reporting tools that collect relevant data from operational systems and create reports on the measured performance levels. Increasingly, KPI results are presented to executives on business intelligence dashboards or performance scoreboards that often include charts and other data visualizations, with the ability to drill down into the performance data for further analysis. Multiple KPIs also underlie balanced scorecard frameworks that pull together sets of metrics in an effort to provide a broader view of business performance beyond operating income and other common financial measurements. One of the challenges in setting key performance indicators is deciding how many to track to determine organizational success. Having too many KPIs may dilute the attention paid to the truly important ones. As a result, it may be more effective to limit the scope to small sets of indicators. Managers must continually evaluate KPIs to ensure they're still relevant and aligned with priorities in business operations. If individual KPIs no longer serve a useful purpose, they need to either be refined or replaced altogether. Number 3, examples of key performance indicators. Beyond revenue, expenses, and profit, commonly used financial KPIs include gross and net profit margin, which measure how much money a company makes on sales of products. Inventory turnover, which tracks how quickly products held in inventory are sold. Cost of goods sold, a measure of the materials and labor costs incurred in making products. Accounts receivable turnover, a ratio that quantifies how quickly payments on credit sales are collected from customers. And days sales outstanding, a related metric which gauges the number of days worth of receivables that have yet to be collected. Marketing and sales KPIs include lead conversion rate, which measures the percentage of sales leads that are successfully turned into customers. Customer acquisition cost, which calculates the average cost of acquiring new customers in marketing and sales expenses. Return on marketing investment, for quantifying the financial payback of marketing campaigns and programs. Customer lifetime value, a prediction of the total profit a company is likely to make from sales to individual customers. And customer churn rate, a measurement of how many customers stop buying a company's products. Key performance indicators in customer service call centers include first call resolution rate, which tracks the percentage of incoming inquiries from customers that are addressed without the need for additional calls. Cost per call, for quantifying the average cost of handling calls. Call volume, which measures the total number of calls handled during a particular period. Hold time, a measure of the average time customers spend on hold during calls. And call abandonment, the rate at which customers hang up while waiting on hold. KPIs for manufacturing and supply chain operations include the percentage of defective products made by a company. Manufacturing cycle time, which measures how long it takes to make products. Carrying cost, which puts a value on what it costs to keep products in inventory. Percentage out of stock items, for tracking the number of products that aren't available in inventory when customers order them. Number 2, limitations of using key performance indicators. Some of the disadvantages to using KPIs include the long time frame required for KPIs to provide meaningful data. They require constant monitoring and close follow-up to be useful. They open up the possibility for managers to game KPIs. Quality has a tendency to drop when managers are hyper-focused on productivity KPIs. Employees can be pushed too hard aiming specifically for KPIs. Number 1, special considerations. KPIs do not necessarily have to be solely tied to financial data. While profits and debt levels are indeed important to key financial indicators, a company's relationships with both its customers and its employees are no less important to establishing its general health. Do let us know in the comments what KPIs you are using to improve your business. Thanks for watching.